start. We are live on YouTube now. So thank you participants. Thank you all organizers for joining in today's Real Estate Summit 2021 being organized on the theme Untangling the Complexities. I thank all the participating organizations and our joint organizers who have so heartily and with all their efforts they have joined today's program. Thank you, Ketanji. Just for the information of all the organizers and participants, Ketanji has been really proactive in helping in designing the entire program. He has also helped us in getting 2 out of the 4 speakers, and Shailesh Bhai is anyways a part of CTC, so he's also agreed to come on this platform once we told him about the details. So thank you, Ketanji, for all the assistance.
But Shailesh Bhai is our choice.
He's our choice. Yes, he has been the first choice of our. Whenever we design such a topic, the first speaker that comes to our mind is Shailesh Bhai, because of his in-depth knowledge and all. So with this,
like knowledge, even the speakers should not be having monopoly. and Shailesh Bhai is the unilateral choice of everybody all across the country.
Right.
Yeah. Thank you, sir.
Correct. So with this, we come to the end of the inaugural session. I once again thank all the organizers and the presidents and chairmen. We will quickly now go to the first technical session. The session is on GST, contemporary issues in real estate sector, and the learned speaker is Advocate Shri Shailesh Sethji from Mumbai. This session will be anchored by Star, New Delhi, and to introduce the speaker and to moderate the session, we have CA Mrs. Shilpa Sardana from Star. So I'll now hand it over to Shilpa ma'am to please take it forward.
Thank you, sir. Thank you, Tarunji. Good evening to all of you. Hope you all are doing well. Today, on behalf of Star Society for Text Analysis and Research, I welcome to all of you and our learned speaker, Advocate Shailesh Sethji, for today's session on contemporary issues in real estate sector. Before start of the session, I would like to give a brief introduction of our speaker to all of you. Advocate Shailesh Sethji has over 30 years experience in consulting, advisory and litigation practice in the field of indirect tax laws that includes central excise, service tax, customs, state VAT laws, CST and GST. He is a partner in a legal firm, namely Messrs. RBL Legal, having its base in Chennai, Bangalore and Mumbai. Shailesh Sethji has dealt extensively in the area of central excise, service tax, customs, GST, CST, VAT across the entire trade and industry spectrum consisting of manufacturing, service sector and distributive trade representing diverse sectors. He has been a regular faculty at various professional bodies as well as trade and industry forums on his chosen field. He has delivered more than 100 lectures on various aspects of GST all over India. He has contributed numbers of articles in various magazines as well as taxation websites like Sex India Online, etc. He is also associated with various trade industry bodies including Indian Merchant Chambers, Indirect Tax Committee, IDMA, Builder Association of India, etc. in the field of indirect tax. This is all about Advocate Shailesh Sethji. And before start of the session, I also want to share with all of you that during the webinar, if you will have any query or any question, then you can raise your hands or you can put that question in the chat box so that our speaker will take it up at the end of the session. Now, I would like to invite our speaker for his today's deliberation on contemporary issues in real estate sector. Over to you, sir.
Good evening to all of you. And the presidents of SEAE and all the participating, organizing, all the bodies, AIFTP, STAR, Chamber of Tax Consultants, and other bodies also. I find it to be quite privileged and slightly apprehensive, I being the opening batsman of this extremely important and very well, conceived and planned real estate summit. And as an opening batsman, sometimes it becomes too much of a burden. How do I really perform? This could not have come at a better time. And what I really liked about this particular summit is after a long time, I am seeing a particular summit where GST is only playing its own part, but it is not simply GST focused summit covering a particular sector. Sometimes I feel we are doing too much of overdoses of the GST. And GST has its own role to play, but we can't simply sidetrack or dilute or undermine the other laws, be it RERA related or income tax from real estate sector. This is good for all other sectors also. It's now time to slightly, the hype created about the GST, we may have to slightly temper it. It is now time to, because too much of focus is on that. And that's why this is something which I really liked about this particular summit, that, it is a very well conceived, covering all major important aspects concerning the real estate sector. And I really find it to be privileged. Thank you. I'm grateful for giving me this opportunity to, further buttress my, further sharpen my thoughts, further crystallize my thoughts, which I would be sharing with you today. I have about, as I understand, Tarunji, about 1 hour, 10 minutes, 15 minutes or so. We are already learning against time. But considering the depth of the issues which I intend to cover, I will not rush through, even if I'm not able to cover all the issues. This entire presentation will be, all the organizing bodies can share with their members in whatever manner they deem fit. I've already shared it with the SAE. So later on, it can be shared with everybody. All the participants, members, freely. There is nothing. It's 123 slides. But obviously, I will not be covering. Initial slides are all covering statutory provisions and the background of the real estate sector, levy of the indirect tax and all. And then I have identified certain major issues. Let me see whichever issues I can cover. I will also try to take whatever questions, considering the time availability. I will try to take them. Friends, the views which I would be on major issues I would be expressing now on. Most of you would be Arun Bhai, Tarun Bhai, Ketan Bhai, and quite a few my professional colleagues and friends are here today who have been participating. They know that I hold certain views which might be militating against the popular views on the real estate sector, and particularly 3/2019. The views which I would be expressing, obviously as a professional, I am expected to give backup or further strengthen those views by my own reasonings that may be acceptable to somebody. It may or may not be acceptable to the court, but I am never a one to just surrender to the popular opinion on a crucial issue concerning GST. As a professional, we are expected to really read, understand, analyze, and come to a particular position without submitting or surrendering to that. And then leave it to our client, basically, to take a call when there are divergent interpretations possible. These views are obviously the firm in which I am proud to be a partner, me, Raghuraman, and Vaithiswaran, our RVS legal. So in effect, I would be also expressing these views as if these are the views of our firm. With this short note, let me come straight to the subject. I will proceed on the presumption that by now, all of us, all the participants who are today right there present here in this webinar are aware of the basic nuances of 3/2019. So considering the constraints of the time, I will not go into the background. I will not go into the salient features of this notification. I will not go into how there has been a radical departure from negative list to GST and from GST up to 31st March 2019 and then after 1/4/2019. I will take it that by and large everybody would be by now would be available. I mean, this is all part of my presentation, but I would not like to dwell too much onto that. So with this, today my entire discussion will be in the context of 3/2019, which is not an independent notification. It is a notification issued on 29th March 2019, effective from 1/4/2019, amending notification number 11/2017, central tax rate dated 28/6/2017. So the parent notification remains the 11/2017 central tax rate, which has been amended by 3/2019. Simultaneously, there are 5 other notifications. Notifications number 4/2019, amending notification number 12/2017 CTR, and then 5, 6, 7. and 8. These are the other notifications issued on the same date, whereby the complete real estate sector taxation was revamped by the government, whatever may be the compelling circumstances or whatever may be the justification of that. And certain issues arising out of this, I would be dealing with that. I'll come straight to the particular slide from where I will take it. Yes. The first issue is, as I said, 3/2019 central tax rate is amending notification number 11/2017. If you very closely see 11/2017 notification and this amending notification 3 of 2019 have been issued under section 9134, section 11.1, section 15.5, section 16.1, and section 148. The question here is, this is a very unique way of issuing a notification by referring to the different provisions which are the mother source of issue of the notification in different circumstances. For instance, section 9/3 allows the central government to issue, notify certain supplies on the recommendation of the council where the service GST liability will be payable by the recipient. So basically 9.3 is a reverse charge mechanism related powers vesting in the central government. So it's a source of power for the central government to prescribe the reverse charge for the specified supplies. 9.4 is empowering the central government to notify certain class of persons who will be obtaining supplies from the unregistered persons. So it's a mother source of power for them. 11.1 is obviously exemption from tax. It is a standard, a normal section you would find, normal provision you would find in any taxation law, whereby the central government under delegated authority would be entitled to issue a notification either partially or fully exempting certain supplies, conditionally or unconditionally. So section 11 is a mother source of power for the central government to notify the exemptions, issue the notification providing for the exemption. Section 15.5 refers to the valuation provisions. Section 16.1 refers to, it is the fountainhead of the rule. It is providing for the registered person, allowing him to take the input tax credit on any supplies, inward supplies of inputs or services, goods or services or both, which are used by him for the business purposes. And section 148 allows the government to notify the board the special procedure for certain specified class of person with regard to the furnishing of returns, registration, and payment of tax, etc. It is basically in the nature of a procedural thing whereby such a certain class of person, a special procedure can be notified. The issue is that as we have always seen under excise and also under service tax, the tariff rate is mentioned. Like excise, it was a schedule, section 3, which is a charging provision, and tariff rate will be mentioned in the schedule against the entries. And then there will be the exemption notification under Rule 8, whereby the either partial or full exemption would be given conditionally or unconditionally. Similarly, under service tax, the rate was prescribed under section 66A as a charging provision, and providing for the partial or full exemption, the notification would have been issued under section 94. And like our mega exemption notification 25/2012. For reverse charge, we had a notification number 30/2012. For small scale service provider, we had a separate notification under 33/2012, 10 lakh exemption. This has been, even custom also you will find that under section 25, there will be a separate notification, whereas the custom tariff rate would prescribe the tariff rate. In GST, if you very carefully see charging provision, section 9.1 itself provides for the prescription of the tariff rate by the central government through a notification to be issued on the recommendation of the GST Council. This is a very, very unique thing, whereby the tariff rate itself are being prescribed by the central government through notification on the recommendation of the council. So far, so good. However, if you see the GST notification for the goods, you will find that there are two separate notifications. One providing the tariff rate, that is 1/2017, and another providing for the exemption from that, 2/2017. For some reason, in services, for whatever may be the reason, this age-old practice has been done away with, and you have a hybrid mixture of various provisions, all simultaneously invoked for issuing an exemption notification. If I call 311/2017 an exemption notification, which it is. And what we find is the 3/2019 obviously follows the same suit. The first question arises in this context is whether such practice is valid practice, whether it has a sanctity in law or not. Section 9(1), which, as I said, is a charging provision whereby central government can prescribe loosely called what is known as a tariff rate. If you very carefully read the section 9(1), it only allows the central government to prescribe the rate of tax, but it does not allow to prescribe the rate of tax with conditions. 9(1) does not allow the central government to prescribe any conditions. They can simply sit or notify the rates on the recommendation of the council for any supply of goods or services or both. And under these circumstances, when 9(1) is invoked, and simultaneously in the column 5 of the table to the notification, when various conditions are mentioned for the prescription of the concessional rate of 1% and 5%, can it be considered as a valid and constitutional? This is my first proposition. Am I supposed to ignore the conditions and treat 1%, that is 3.75%, and I'm not going into that nitty-gritty. We will talk about only 1% and 5% effective rate. Whether 1% and 5% rate prescribed through 3/2019, shall I simply turn my blind eye to the condition part and treat this as a tariff rate? The relevance of this I will come down in a few minutes. So the important thing is 9(1) does not allow the central government to prescribe any conditions while prescribing the tariff rate. If we apply this test, on this test, notification 3/2019, for that matter, even 11/2017 fails. Coming to 9/3. 9/3 is only about the reverse charge mechanism in case of the specified categories of supplies. As you are aware, the new items which have been inserted at entry 3 of the notification in 11/2017, in some cases, the liability to pay tax has been actually shifted to the promoter developer in majority of the cases. Now that reverse charge mechanism has been simultaneously clubbed into this notification. Assuming for a moment that this may not be illegal, I have my reservations, I'm not going into detail about this, but assuming for a moment that if this is the not illegal, if this is an absolutely arbitrary and the absurd way of actually issuing the notification. For what reason RCM notification was not separately issued, whether they were too tired to do that or they felt too bored to do that, I don't know that. Where was the problem in issuing a separate RCM notification? Similarly, section 9(4) provides for the RCM in case of specified class of person obtaining the supplies from the unregistered person. As you are aware, till 1/2/2019, there was a controversy about the normal supplies being obtained from unregistered person. That was 1/7/2017 onwards. Even if you buy a pen from the stationery mart, then on that, if he is an unregistered person, there was a levy of GST on the RCM under the original provision. There was a hue and cry, and then finally those provisions were kept under suspension, and ultimately entire 9(4) has been substituted with effect from 1/2/2019, whereby only specified class of persons are brought under the RCM for the supplies from the unregistered person. And the only class of persons who are today victims of this new provision is real estate sector. As of now, no other class of person or sector has been notified under section 9(4), making them liable to pay the tax under RCM on the supplies obtained from the unregistered person. There has been a lot of confusion and all sorts of audit objections going on even today. After 1/2/2019 also, audit objections are being raised, demanding the tax on the RCM from the unregistered supplies, which is absolutely illegal, because this provision is made applicable only for the real estate sector. Here, another point is, RCM is not a tariff notification, as we call it. RCM, under excise and custom, we are used to tariff and non-tariff notification. Reverse charge mechanism is only basically a mechanism providing for the payment of tax by another person in certain circumstances. Their government is not notifying any rate. The rate remains what has been prescribed. Either entire liability is shifted to the recipient or it is divided between the recipient and the supplier. But the rate is not actually prescribed. I don't know why the RCM notifications are being issued as a rate notification. Why can't it be issued as a simple central tax notifications? This is another mockery of the entire legislative process. Because there is no rate of tax involved in the RCM. Rate of tax is already crystallized and finalized. You are only shifting the liability. It is a procedural thing, if I can say that. You are shifting the liability to other person. You are not determining the rate. Coming to 12/2017, which has been issued, there is another very interesting thing. Before that, I will come to next slide. Going forward, 11.1. There is no difficulty about 11.1. It gives the central government powers to provide for the exemption partially or fully, conditionally or unconditionally. But if you see, this notification comes into play. This power can be exercised by central government only after the tariff rate is prescribed. Unless and until 9.1 is implemented and tariff rate is prescribed, the actual maximum rate which can be levied on a particular supply is prescribed by the government. 11.1 cannot come into play.
Sir, may I interrupt a little bit?
Sorry?
Sir, may I interrupt a little bit?
Yeah, please.
Sir, if you can put the slide on a slideshow mode so that the entire screen becomes bigger.
Okay, fine. Okay, I'll do that. There is a slide slow. There is something. I don't know where is slide. I'm able to find this slide slow. One minute.
Slide. Sir, at the bottom on the right hand side.
Actually, in my laptop.
Sir, यहाँ पे दिख रहा है ना, the second icon, it says from current slide. If you click that.
Acha, okay.
हाँ बस. Yes, sir.
Acha, now it is clear?
Yes, sir. Yes, now it's okay, sir.
Arun ji, ठीक है?
Yes, sir. Absolutely.
Okay. Fine. Now, if you see, the section 9.1 prescribes the tariff rate. Unless and until the tariff rate is prescribed, there cannot, 11.1 cannot come into play. Now, 9.1 does not allow central government to prescribe the conditions, and 11.1 cannot simply prescribe the conditions. 9.1 does not allow the central government to prescribe the conditions while prescribing the tariff rate, and 11.1 does not allow the central government to prescribe only conditions. They have to prescribe a full exemption nil rate or exemption. It does that mean that while invoking 9.1 and 11.1 both simultaneously, does the central government want us, does the government or legislature want us that you read the concessional rate of 1% and 5% under 9.1 and you read the conditions under 11.1? Can this be permissible in law? In my humble opinion, no. I am not supposed to bifurcate a part of the part of the notification and trace it under a particular provision and another part under another provision. Section 15.5 is only allowing the central government to prescribe the manner for the determination of value of the notified supplies. This particular section 15.5, I am not going into the text, it is part of my presentation. If you read carefully, 15.5 has actually no role to play as far as this particular mechanism of providing for the taxation structure through the notification is concerned. And lastly, section 16.1. Section 16.1 does not even allow the central government, does not even provide for the issue of any notification by the central government. There is no word anywhere that a registered person shall be allowed to take the input tax credit on the supplies of the goods or services or both in the manner as may be notified by the central government on the recommendation of the council. There is no mention. Central government does not even provide for the issue of the notification. How can section 16(1) be invoked on for issuing the 3/2011? And the lastly, section 148 is only providing for the special procedure for certain process regarding the furnishing of returns, payment of tax, and administration of such persons. Considering the wide-ranging power in a way vested, this is a very dangerous notification, and it has been completely misused over last 4 years, unfortunately, on number of occasions. I'm not going into while extending the returns date and 3B dates and all. It has been used indiscriminately over last 4 years. So the question here is that it is my humble and very firm view that this notification at its inception is absolutely invalid and unconstitutional per se. The entire notification can fail on the touchstone of its validity, considering the various powers which have been invoked under that. If you see now coming to 12/2017 also, 12/2017 is more or less the replica of mega exemption notification 25/2012. If you very carefully see, it adopts most of the earlier entries of the 25/2012. This has been amended by 4/2019. Now, apart from certain amendment relating to the reverse charge and development rights liability and salami and upfront payment and all, you will also find that the first amendment which has been made is to the opening paragraph of 12/2017. And 12/2017 notification is in exercise of the powers conferred under section 11(1) by the central government. There was only one section which has been invoked under 12. However, this 11(1) has now been substituted by 9(3) and 4, 15(1), 11(1), and 148 all. Can this be done? I have my very, very serious reservations. Because 9(3) and 4 are independent source of notifications for reverse charge mechanism. 15(1) deals with the valuation. 148 deals with the special procedure which can be prescribed for certain class of persons. These are all independent source of powers for undertaking certain acts by the central government on the recommendation of the council. How can a notification issued under 11(1) can be amended to incorporate all these very independent sources as one of the sources in the notification? I have my reservations, very serious reservations. Coming to, so in my humble opinion, 3/2019, its very validity fundamentally is susceptible to very, very serious challenge. With this, we come to the next point. This conditional notification, all along, it has been projected as a mandatory notification by the government. All the FAQ, government, various flyers and interactions, the popular opinion amongst the sector, among the professionals is this, that today, 3/2019 prescribing the revamped tax structure is mandatory. Why? Because the notification itself says that the rate prescribed in this notification shall prevail upon the rate against any other. And I mean, one has no option to pay the tax. Can it be so? If you see, this notification fundamentally traces its powers or source only to section 11(1). If it is under 11(1), there is a section 11 carries an explanation. That explanation says that if exemption has been granted unconditionally and absolutely, then it cannot be forgone. This is the legacy from the excise laws. Section 5A2, there was this provision. In service tax, there was never a provision that you cannot forgo. However, in excise, there was a provision. It came under certain circumstances, but it became part of the law later. Now, the question here is, it cannot be denied by anybody that 3/2019, which provides for the 1% and 5% rate of tax, is subject to host of conditions. Once the conditions are prescribed, can it be said that this 1% and 5% is unconditional? Can it be said at all? The moment one single condition is prescribed, the notification becomes optional, because that is what the law itself says. That is what the Section 11 explanation says. And therefore, the contention or the claim by anyone, including government, that 3/2019 is a mandatory notification, the rate prescribed is mandatory, that has no, that has no basically the sanctity in law, it has no approval of law, because the very Section 11 does not say so. The only way the rate can be considered as a mandatory rate, 1% and 5%, by treating it as a tariff rate. But if this is a tariff rate, then why this notification condition? Because then I have to ignore the conditions and treat this as a tariff rate. Government cannot actually, this cannot be allowed. I'm aghast. I've never seen such type of legislative process. It is a mockery. That to call it mandatory, treat it as a tariff rate. But to implement that so-called tariff rate or concessional rate, you actually adhere to various conditions also. So I am not letting you without conditions. But my conditions will come into play provided you consider it as a tariff rate. How can both go together? Particularly when the very charging provision does not allow the conditions to be prescribed. So am I supposed to ignore the conditions? Then the whole notification collapses. Another point is, when there is a conditional exemption, there has to be clarity and surety about what consequences will follow if the condition or any of the conditions is not met with. There has to be. The various conditions prescribed in column 5 of notification 3/2019, what happens if any of these conditions is not actually fulfilled by the taxpayer? What consequences will follow? Is there any answer? Then how can it be said to be a mandatory notification? If the condition is not fulfilled, will the department demand the tax at the full applicable rate? Can it do so? So even from this perspective, the contention that this is a mandatory notification, a mandatory rate to be applied, in that condition is, very difficult to accept. Coming to the omission of the entry of works contract from this is another very extremely intricate and very, very serious proposition. If you see the pre-1/4/2019 entry 3 clause 2, it contained composite supply of works contract service. For some inexplicable reasons, this entry has been completely omitted from the notification, and new entries have been provided. There is a residual entry 12, Roman 12, that is item number Roman 12, which has been amended, and the amended item 12 of entry 3, this is by 3/2019, it speaks about the construction services other than those covered by item 1, 2, all 1A, 1B, and all. So these are no. Now, if you see, what are the implications of this? It cannot be anybody's case that a construction contract is a works contract unless it has been given as a pure labor contract. 1. 2, there is a difference between composite and indivisible. If you go through the history of all the judgments of the Supreme Court dealing with the works contract, they have talked about the indivisible contracts. The word both used in the charging provision and in the constitutional provision that GST is a tax on the supply of goods or services or both. Does the both word convey a composite nature or the indivisible nature? As a matter of fact, both is one of the poorest expression used in the entire legislation. Both does not convey anything actually. It is an extremely slippery and extremely vague expression. A works contract is an indivisible contract. There is a difference between the composite and the indivisible. Now, having said that, works contract definition under section 2 subsection 119 also covers construction activity. And once the composite supply, assuming this is a composite supply of works contract, that entry having been omitted, all the new items starts with construction services or construction of affordable residential apartment or construction of residential apartment other than affordable apartment. You will also find that at entry number 6A, 7, 8, the legislature has continued to use the expression composite supply of construction of works contract of construction. They have continued to use this expression also. In other words, expression construction of services and composite supply of services, they cannot be considered as synonymous to each other. They are not actually at par with each other. And here the problem arises because if we apply the LNT, 2014 LNT, Honorable Justice Rohinton Nariman, who just retired, the Justice Nariman judgment, prior to 1/6/2007, there was no levy on the construction activity which were in the nature of the works contract. And the pre-existing entry of section 65(105), residential construction and commercial construction, only covered the pure service, but not the works contract. This judgment principle, will it not come into play? In the new items, only the word used is construction. Unlike other items, let's say item number 5A and other such item, you will see 5A and subsequent entries also, composite supply of works contract they have used. Going from this perspective, the entire levy on the developers, builders, as well as the pure contractors, private contractors and private builders, in my humble opinion, fails as of now. If we apply the L&T case and ratio that a construction, purely construction can only cover only labor, cannot cover the composite supply of works contract, then this new item, which uses the expression construction only, but not the composite supply of works contract, and in the absence of any other entry relating to works contract, the entire levy can fail and fails in my humble opinion. If you see the residual entry also, it speaks about the construction service. The other implications of this is that omission of the entry on works contract, now linking it to the option available to the taxpayer. Do they have any other option to forgo 1% or 5%, particularly for the reason that there is no ITC available? Can they go under residual entry 12? Residual entry 12 says construction services other than so-and-so, so-and-so. Now, if you see other than means, obviously a developer undertaking the construction of the residential or commercial apartment and selling it, say residential apartment and selling it in the market, he is engaged into the works contract. And because it is a works contract, and works contract definition includes construction, therefore, anything other than those can be said to be covered by residual entry 12. In my humble opinion, it is permissible for the builder or developer to pay the service tax, to go for the full applicable rate, to pay the tax on the entire value by excluding the actual land value, not 1/3, actual land value as per the ready reckoner or income tax, whatever, I mean, stamp duty purpose, whatever is accepted, and then take full credit of ITC of the tax paid on the input services and capital goods. This option is available to the builder developer even today, assuming the very levy is there. In my humble opinion, with the omission of the works contract related entry, government has actually messed up the whole affair. They have actually harmed themselves because the entire levies can be susceptible to a very serious challenge. And it can be said that all the new items of entry 3 inserted by 3/2019 applies only to the pure labor service. It cannot apply to the construction activity, which is in the nature of works contract, applying the ratio of the L&T case. However, assuming the levy's validity, the builder developer still has the option to pay the tax at the full applicable rate, claim the full exemption of the land value, take the full credit of the tax paid on input service, inputs and capital goods. However, the customer may be a stumbling block or maybe resisting because customer is more interested in 5%. He would not understand all these intricacies and niceties and nitty-gritties. Builder can charge customer only 5%, but pay the government to the full applicable rate. And while availing the ITC, this option is available in my humble opinion. The next is about this is what I have already covered. Coming to another aspect is the inclusion. Assuming for the moment that the everything 3/2019 is valid, the levy is valid, we now come to the valuation mechanism. Para 2 has been made applicable to all the new items. And Para 2 speaks for the valuation. It says the value of land shall be deemed to be 1/3 of the total amount, including the amount charged for the land. Now, what happens if the land value is more than 1/3, which is common at least in the cities like Mumbai, where sometimes the land value itself forms about 60 to 70%, 50, 60, 70% of the total cost of the construction. If 1/3 as a notional deduction is made available, is it not that the anything value which is in excess of 1/3 becomes part of my overall taxable value on which the tax is being charged by the government? Is it not then the tax on the land, on the immobile property? If that is the case, is it permissible? Is it constitutional? Can directly or indirectly union charge the GST on the immobile property like land? Whether legislative competence of the union extends to in this manner? If you see, I will also deal with this when I deal with the immobile property part, TDR and all. My point is today that if we do a harmonious reading of Article 246A, which has been inserted by 101st Constitutional Amendment Act to pave the way for the levy of GST, it is a mother source of the levy for the legislation for the GST levy. Article 246A, which is starting with the non-obstante clause and is overriding Article 246 and 251. But at the same time, the state list not undergoing any change, particularly entry 18 and entry 49. Even indirect levy of GST on the land value is unconstitutional. A challenge is already lying before the Gujarat High Court very recently in Munjal Manish Bhatt case, and the notice has been issued. Again, Para 5B also. Para 5B of the Schedule 2 to the CGST Act, which provides for the CC, before CC if you have received the payment. That can also be susceptible to change in view of because it is patently violative of Article 246 and 265. The presumption also does not really find favor that value of land is 1/3. It is arbitrary, unreasonable, and it is purely not backed by any credible basis whatsoever. So the very Para 2 again can be susceptible to the constitutional challenges. Next comes to is coming to the entry 5B. If you see, first of all, let me clarify. I've been saying this from the day one since 2017, that Schedule 2 was never, and Schedule 2 is not a deeming fiction. Schedule 2 is merely categorization of supplies. It has never been a deeming fiction. It was given a character of deeming fiction by advance authority rulings, unfortunately, but expectedly, and by we the professionals, unfortunately. It was never an intention. If a particular transaction or activity qualifies to be a supply in terms of Section 7 and the prerequisites laid down therein, then only for the purpose of categorization, whether it is a supply of goods or supply of services, in a given case, one may refer to Schedule 2. Schedule 2 need not be referred in every case. It does not even provide for that. But something which is categorized as supply of goods or supply of service does not automatically become taxable merely because it is included in Schedule 2. This has been made clear, fortunately, by the board after through the retrospective amendment in 2019 of the Amendment Act of 2018. And board understood that the matter is going too far. And there is complete, it was a very badly worded section 7, no doubt. I mean, there can be a justification for this, the views which were being taken, because it was a hopelessly worded pre-amended section 7. But now it is very clear under the retrospective amendment, and therefore the Schedule 2 can be resorted to only and only if a particular transaction or activity merits the fulfills the criteria of being called a taxable supply as per section 7.1. And this is now new clause 1A has made it very clear. That being the case, when we see entry 5B will come into play only if the activity undertaken by the builder developer is a supply. That supply as per section 7. Section 7 which defines the term supply says it is a supply of goods or services or both. And it sources its power to Article 246A. Article 246A also speaks about the supply of goods or GST levy of supply of goods or services or both. Nowhere it says about the immobile property. And that being the case, if the Section 7 itself is not fulfilled for the construction activity, whether entry 5B can make it taxable, in my humble opinion, no. It is also pertinent to note here that entry 5B is also in conflict with Article 366(29)AB. Article 366(29)AB has been retained even after GST has come into force. This is a very, very interesting thing. The legislature has not done away with, Parliament has not done away with Article 366(29)AB. This aspect should be kept in mind. I'm not going too detailed into that because that considering the time and I have to cover a lot many things. Next is the transfer of development rights. This has been an hot issue. In the context of 3/2019, the transfer of development rights comes into play in different scenario. One, where there is an arrangement between the landowner and the builder under the joint development agreement. In a city like Mumbai, the builder developer may buy the TDR independently, which is sold in the market like any other shares of the stock market. They may buy the TDR. The development rights transfer issue, if I can call it a transfer, may come into play when the redevelopment activity is undertaken by, say, by a society. A society which has its own FSI available, they may actually vest that FSI into a builder developer while undertaking the redevelopment. And that FSI can be exploited by the builder after independently or after actually procuring additional TDR also for the construction of the sellable area which he sells in the market. In all these cases, call it development rights, these are all independent terms, development rights or the TDR, transferable development rights, or FSI, can they be subjected to tax? Because the exemption granted to the supply of transfer development rights by notification 6/2019 and subject to the condition that on the unbooked area on the issue of the date of issue of the completion certificate, a proportionate levy will be discharged by the developer. Actually proceeds on the assumption that development right, transfer of development rights is a taxable supply. Is it correct? This is where we have to just pause and ask ourselves a question. Without going into details of the development rights, what is development rights and all, the Schedule 3 excludes sale of land and sale of building other than under construction from the scope. It is neither a supply of goods nor a supply of services. It excludes that. The first proposition is here, whether is it really necessary to mention Schedule 3 sale of land specifically? Was there any need to do so also? In my opinion, it was never required because land being an immobile property, it was already outside the purview of the GST law, even otherwise. There was no need for mention. Even if it would not have been mentioned, it could not have been subjected to tax under the wide-ranging definition of service. Service means anything other than goods. Service means anything other than goods cannot cover immobile property like land, because Article 246A itself does not allow that. Article 246A starts with the non-obstante clause. But that non-obstante clause overrides Article 246, which provides for the demarcation of taxation and legislative powers between the union and the states through the list 1 and through the list 2. Under these circumstances, when the entry 18 and 49 is already undisturbed after GST has come into play. One, making legislation relating to the tax on land and taxation on land, this has remained the power within the domain of the state government only, land and buildings. This being the case, once we keep this fundamental thing in mind, the constitutionally, when GST was introduced, constitutional provisions do not even provide for the levy of GST on any immobile property, including land. And if you go by the definition of land, it says land includes the rights or benefits arising from or attached to the land. All definition. Even the entry 18 also of State List 2 speaks about rights arising from, and other Land Acquisition Act, Registration Act, General Clauses Act, they all define, including Income Tax Act, Section 269 UA probably. It also speaks about the rights arising from the land, in effect. And it cannot be anybody's case that development rights or FSI are not the rights or benefits attached to or arising from the land. And therefore, they will get covered by land. Land is always covered by the immobile property. Obviously, land is covered by the immobile property definition. Therefore, unlike Section 65B44 of the Finance Act 1994, which defines service so as to and excluded immobile property, that immobile property not finding the place in the service definition or in Schedule 3, in my humble opinion, does not make any difference. It is immaterial whether it is mentioned or not. Even sale of land and sale of building was also not required to be mentioned. It is a misnomer or maybe abundant precaution. It may be by way of abundant precaution only. But without that also, it could not be subjected to tax. That being the case, applying the ratio of Sarvodaya Society case and the Chheda Housing Board case, and there are a host of decisions by the high courts, including Bombay High Court and Supreme Court. The tribunal decision in DLF case in the context of service tax, Allahabad bench, if you apply the development rights or FSI or TDR, being the rights or benefits arising from the land, cannot be subjected to tax at all. That being the case, the exemption granted to it, initial exemption granted, and subsequent recovery in certain circumstances under reverse charge is absolutely, I mean, you know, it is a self-serving exercise undertaken by the legislature. Because it proceeds on the presumption that there can be a levy on the development rights. No doubt, issue is highly debatable, and particularly the very taxation of the land and building, whether it falls within the union power or not in the certain circumstances, like in the royalty, mining royalty, it is already pending before the 9 judges bench of the Honorable Supreme Court in Mineral Development Corporation versus Steel Authority of India, which has been recently also referred to in the Z network case. It is pending, and I am now told that issue is now being taken up probably by the 12 judges bench or maybe 15 judges bench. One can only wish that on this extremely important issue with a tremendous impact across the country, because crores and crores of rupees of revenue is actually riding on this particular issue, and it can have a tremendous impact everywhere. At least one way or another, Honorable Supreme Court will come out with its verdict sooner rather than the later, because this issue is hanging fire for long. But till then, it is possible and permissible, and maybe one can take a stand that there cannot be levy on the development rights transfer at all. Coming to the another part of the development rights is the landowner. Suppose there is a landowner and the builder agreement, under which development rights are transferred by the while retaining the ownership, which is permissible in law. Any rights in the land is a bundle of rights, And each such bundle of rights, right to use, right to enter, right to license, right to actually develop, right to own, these are all bundle of rights. And all these rights are severable. They can be segregated, as Supreme Court said in Syndicate Bank case, and there are a number of judgments on this case. So even while retaining the ownership, a landowner can actually transfer the development rights to the developer. Now, against that, he gets the consideration in the form of constructed area. Suppose it is an area sharing arrangement. Now, on that construction activity, whether the builder or developer is liable to pay the tax or not, the notification seems to suggest yes. On the promoter side, landowner side, it says if the landowner promoter who has transferred the development rights and whatever constructed area he is getting, if he sells that constructed area before issue of the completion certificate, he will also be required to pay the tax, which shall not be less than the the tax payable ID. I mean, he is required to pay the tax, one, and however, he will be entitled for the ITC. This is only exception in 3/2019, which says that he will be entitled for the ITC of whatever tax has been charged to him by the builder. Now, in this entire context of JDA, there are many, many aspects of JDA which are all controversial and extremely debatable. I'm only touching upon a couple of aspects. The first is whether the developer is liable to pay the tax on the constructed area. Is it not a barter? Whether the intention of both the parties, when a landowner transfers the development rights, is he looking for any supply of service of construction in the form of constructed area, whether it is a consideration or whether it is a supply from the land? That is one part. Secondly, is it not a barter? Because development rights, if it is covered by the land definition, as I said, will it not be the barter in the immovable property? It is possible to take this stand. The other part is that it provides for the assuming the levy on the constructed area given by the developer to the landowner. The levy provides for the valuation based on the similar apartment sold nearest to the time to the independent buyer. This is an impossible condition in certain circumstances which can be fulfilled. What happens when the constructed area is given by the developer, say today, to the landowner as per the JDA arrangement? At that time, there is no independent sale to any independent buyer by the developer in that particular project. What happens if that particular first independent sale takes place after 3 years or 4 years or maybe 5 years? Can that price be the subject matter of can be the basis for determining the levy, and at what point of time? Law does not compel somebody to do the impossible. And there cannot be a law which depends upon something which is absolutely uncertain in its first instance itself. When the levy cannot hinge upon uncertain factors, the concept of similar apartment, valuation of the similar apartment sold to the independent buyers, I'll come to that in a minute. I have something to say on this also. So in my humble opinion, assuming the levy, since the valuation mechanism fails on different counts, the levy fails as held by the Supreme Court in the B.C. Srinivasa Setty's case, Govind Saran Gangasaran case, Nathuram Agarwal case. The 4 components of the valid levy of tax, one of them is the valuation, measure of tax. If that fails, the levy fails. Coming to the, I've covered. Another part is coming to the landowner promoter. The expression used is the registered person. If you see very carefully column 5 and the condition prescribed by notification against this entry, you will find that the landowner promoter has been actually described as a registered person. Now, what happens if the landowner promoter is not a registered person, because independently he is not engaged into any taxable supply, and there are thousands of people who are sitting on the land bank and who are not otherwise engaged into any taxable supply. They may become taxable applying the notification if they acquire the constructed area as a consideration from the developer under JDA and sell part of it before CC. That will probably make it, assuming the validity of this condition also, that will make it liable to take the registration for the first time. But the very landowner promoter has been described as a registered person. And if on the given date, when the levy arises, if he is not a registered person, then what? Why they should use the word registered person? Unless somebody says that registered person means a person who is also liable to take the registration. This is a highly debatable issue, one aspect. The other part is about what shall be the rate of tax in the hands of the landowner. Assuming everything, I'm assuming levy's validity on all 4 counts. Now let us go further. That when the landowner sells his part of the constructed area to an independent buyer before CC, at what rate of tax he should pay? 1% or forget about 1%. We will only talk about non-affordable 5%. 5%, where is the provision which specifically says that he should pay it at the 5%? Neither the condition says, nor the provision of law says. It's a board circular which says it will be at 5%. No doubt contemporaneous ex exposito. Board circular will be binding, FAQ will be binding. But again, this is a very, very poor way of actually drafting the notification and prescribing the condition. Because if you see, the developer promoter shall pay the tax, and then such landowner pays the tax on the same which is not less than the amount of tax. If you see, on the constructed area where the landowner promoter expected to pay the tax, the condition uses the expression, he shall pay the tax on the same which is not less than the amount of tax charged from him. Not less than the amount of tax charged on him. Okay, fine. So if the builder developer has charged the landowner 5%, the levy, the tax liability of the landowner cannot be below 5%. Assume. But that is only one part of it. But then what is exactly the rate of tax? Not below 5% is understandable, but it does not mean it should be 5%. Let me repeat. Not below 5% is acceptable, but it does not mean it is 5%. So what it is? In my humble opinion, there is absolutely no specific rate of tax made applicable for the promoter, landowner promoter. As of now, even from this count, applying the basis Srinivasa Shetty, the entire levy fails as far as the tax charge being charged on the promoter is concerned, because there is no rate of tax prescribed for them. The other part is about the provisions. I will, para 2A speaks about value of construction is deemed to be the equal to the total amount charged for similar apartment under JDA arrangement, which is nearest to the date on which DRI or FSI. What is meant by nearest? If my independent sale takes place, as I said, after 3 years from entering into the JDA, can it be said as a nearest? Can the subject matter of a levy of tax, such a serious constitutional matter, be a subject matter of the such a whimsical type of provisions? And another thing is, development rights is purely a consideration in kind. If it is a consideration in kind in the hands of, it is a consideration in kind received by the developer, the valuation rules, right from Rule 27 to Rule 32, if you one carefully analyzes each and every rule of valuation, CGST valuation rules, one would find it is, in my humble view, there is not a single rule as of now prescribed under valuation rules which covers a situation when an entire consideration is in kind. Rule 27 only talks about when the consideration is partly in kind and partly in monetary, whatever may be the heading of the rule. The two illustrations given at the end of Rule 27 and the careful reading of Rule 27 will clearly show that there is no mechanism provided for the valuation when the entire activity, entire consideration is in kind. This is unlike service tax valuation rules. They were better drafted. But here there is no provision. The two illustrations make it also clear also that there should be a partly, it is applicable only when there is a partly in kind, partly in money. And therefore, going forward, again, assuming the levy valuation mechanism, if I have to apply, as a worst case scenario, it can be only cost of construction method. It cannot be the valuation of the similar apartment sold to the independent buyer, as far as the developer's liability to pay the tax on the constructed area given to the promoter. As far as the promoter landowner is concerned, in my opinion, the levy does not stand attracted at all. But for the developer, suppose the liability is to be discharged on the constructed area given by him for the acquisition of the development rights, the valuation can only be on the post-construction method. It cannot be on the basis of the similar value of the similar apartment sold, irrespective of what the notification says. The other part is about the very important part, if you can see the compare going forward, that the prior to 1/4/2019, this concept of landowner promoter was never in the vogue. It was not even specified anywhere under the provision of notification or under the law. Going forward, going back also, prior to GST, under service tax also, there was no provision prescribing the levy of service tax on any landowner who will be selling the constructed area given to him, received by him as a consideration for transfer of development rights, and which he sells before CC, obtained by the developer. The whole levy, in one way or another, sought to be actually justified by the board by its circular, which has no validity in the eyes of law. Board cannot actually create a levy through a circular, much less implement. Neither can assume nor can create. So it was a board circular which has been now verbatim reproduced in the notification text. If you very carefully see, that circular number 151 of February 2012. It has now found verbatim reproduction in notification 3/2019 as far as this JDA arrangement is concerned. So those past cases where a landowner who has transferred the development rights to the developer, and against that he has got some constructed area, and that constructed area is sold by him even before CC, the levy did not even exist at all. Actually did not exist. And the levy which is now sought to be introduced is also unconstitutional in my opinion. Another important principle is an exemption notification cannot assume nor can it create the levy. I've dealt with this aspect in my first article on the interpretation of exemption in the what Ketan Bhai has talked about the journal, July journal. I have talked about this. The landowner promoter related condition presumes or either creates the levy which is not permissible in law. It presumes that they are always liable. Suppose this condition had not been there in the notification, under which provision of law of CGST Act or the exemption notification, a landowner selling his area of constructed area in the market can be subjected to levy of tax. There is not a single provision. Not a single provision. So can an exemption notification condition assume or create the levy? Answer is no. Similarly, the concept of adoption of the value of the similar apartment sold to the independent buyer was never statutorily prescribed anywhere in earlier service tax regime or in the prior to 1/4/2019 during GST regime from 1/7/2017 onwards. It was never there. It was only via board circular, but it was never there in law. If that be the case, this concept came to be introduced for the first time in the GST via notification. And this particular concept, the entire methodology of valuation been prescribed by adopting the similar apartment being sold. The validity of it is highly questionable on various counts. I have dealt with them. Development rights I have already covered. The transfer of development rights, I'm not going into the detail. Oh, it is already 5:40. I'll just finish this in another 5 minutes. This is the Orissa High Court judgment, Safari Retreat, 17(5)D. I will not deal with it. But coming to the developers, the last two parts, sale of developed plots. There have been a lot of activities across the country in different states and different locations whereby the land is developed actually, and the plotted land or plotted, the developed plots are being sold. And in most of the cases, the owner or developer himself undertakes the requisite development activities, creates the amenities, and then sells it as a developed plots. The advance authority rulings have held it to be liable to tax by saying that there is a development activity which is a supply of service involved into this. I generally don't like to comment on advance authority ruling because personally I do not go and I do not recommend anybody to go. My only humble submission is this, that friends, before rushing to advance authority ruling on any matter, please do some serious rethinking, introspection, and study. Okay, which are the other actions available, whether it is a classification or whether it is a valuation or whether it is a taxability. Independent study is required. We are actually killing the whole jurisprudence by rushing to the advance authority ruling today. We are killing and we are creating unimaginable the issues and problems for the smooth implementation of this law. This law will never become smooth if we go on rushing to advance authority ruling and if they keep on doling out the type of judgments which are being doled out day in, day out. If somebody tells me why you should not go to advance authority ruling, my simple answer will be, maybe there can be many better ways of committing suicide. That is the only reason sufficient for me to not to go to advance authority ruling. Advance authority ruling is not a shortcut. And there are many, everybody, I can go on this, I will not go into this. Suffice to say, okay, when we talk about a plot developed and sold under joint development agreement by anybody, or a plot developed and sold independently by any developer, whether it is a barren plot or whether it is a developed plot, it is a sale of land only. Whether I sell a developed land or whether I sell a undeveloped land, it is a sale of land only. It is covered by Schedule 3, Entry 5, period. There cannot be levy. In one of the judgments, there has been an unbelievable, absurd, the distinction between in Abhishek Darak case, there was a difference of opinion where member Sri Amit Gupta said, fortunately, that he says sale of developed plots does not constitute the supply of goods or services not exigible for the GST. Whereas member Sri Anurag Misra says assurance to the purchase is as to the nature and extent of development will be carried out. Not only that, Entry 5 Schedule 3 refers to only sale of undeveloped land and not of developed land. It is a supply of service. From where this type of distinction came, I am really aghast to understand. How can a land word used in Schedule 3 be categorized into developed land and undeveloped land? So on plotted development, yes, it's a different matter. If I sell an undeveloped plot of land to a buyer, that buyer again engages me or somebody else as a contractor to create development, to undertake the development activities, to undertake the amenities, to set up the amenities, then it is an independent contract. Either I as an owner of the plot who has sold it to the buyer may undertake it if I am required to under an independent contract. Then that contract can become liable to service tax, but not the original sale of the land. Once the ownership of the land or plot is passed on to the customer, then subsequent development activities undertaken by independent contractor may be subjected to the tax as a supply of service. But not the plotted land which I have undertaken for myself. I'm developing the land for myself and then I'm selling the developed plot, no liability on that. And the last part is about redevelopment. Only 5 minutes I will take. I will not go into details because in Mumbai city, this activity is at the forefront now and it is suddenly become a very hot market. All the organized builders have suddenly found this being a very lucrative and promising market in the real estate sector. In Mumbai alone, it is expected to be worth about 30,000 crores, the redevelopment, because Mumbai has no land. So, and we have a development control regulations also. And redevelopment can take place in two ways: self-redevelopment, where the society undertakes, and the redevelopment through a developer. there are two models. The first model of self-redevelopment is now slowly picking up, but there are issues. But in a typical redevelopment model, society engages a builder, extra FSI is given to the builder as a consideration. Builder pays rent to the existing members and other specified amount, including contribution maybe to the corpus of the society. Builder offers to pay extra area to the existing members. Suppose as per the development control regulation, 35% extra area he is to give. And whatever is otherwise agreed upon, that is in case of slum rehabilitation, etc. In case of redevelopment activity of independent society, builder may agree as a contractual arrangement extra area to be given. Beyond that, a particular member may buy additional area. So original area, 500 square feet, builder may agree to give him another 100 square feet or 150 square feet. Then the member may buy also more than 100 extra area given to him. Now, in all these cases, the liability is to be seen from the builder perspective as well as from the member society perspective. First of all, without going into the self-redevelopment perspective, I will only go to in case of redevelopment, as far as the members are concerned or society is concerned, society is basically acting as a facilitator or the mediator, because all the members, this will be a tripartite agreement between the society, members and the builder developer, whereby each gives their consent to the terms of the agreement of the redevelopment. One, what the member is interested, building is demolished, new building is constructed, and in that he is given whatever area agreed upon by the builder. Can it be subjected to the levy of tax? The builder is giving free of cost to the member, and that free of cost which is given by him, can it be subjected to the tax at all? Is it not basically an exchange of I was already an owner of the flat, and now I am actually getting a new flat by demolishing my original flat, and I am getting it. Can it be made liable to the tax? Assuming for a moment that if free of cost allotment is liable to the tax, then in that case, what can be the valuation? The law says that the revenue seems to say that it should be the similar apartment sold in the same project to independent buyers. I have gone into this aspect. It is not permissible to apply the valuation of the similar apartment from the sellable area being sold by the right. Suffice to say, it will be only the cost construction method as a worst case scenario. It can only be the cost construction method. There cannot be anything else. The levy otherwise also fails because valuation mechanism is not there. But it can be, if at all, it can be cost construction. For the past cases where the Senvet credit has been allowed, the free of cost allotment where the builder has not paid the tax, service tax or GST up to 1/4/2019, Senvet credit or ITC cannot be recovered from them at all, because this is not an exempt supply. The free of cost which is given does not fall within the scope of the exempt supply also. And then the last thing is about, so therefore this liability under RCM does not arise at all, even in this type of redevelopment activity. And finally, the other part is about normally there is nothing like free lunch. The builder, obviously the developer would include the cost of construction of the free of cost flat to be allotted to the existing members in the cost of construction of the sellable area on which it will be paying the GST. And there the Vasanta Green project tribunal decision will come into play. There cannot be a double levy, because my cost of construction of the independent sellable area already includes the cost of construction of the free of cost flats allotted to the members. And therefore, and if I can prove that on the basis of Vasanta Green, though it is in the Supreme Court, the levy cannot arise. As far as the members are concerned, what members get, they get the hardship allowances or the shifting allowances, monthly rent also. Sometimes society gets the corpus. Can they come under the scope of business? Can it come under the scope of supply? The answer is no. The builders, in the Sankar Bhanusali case, the first judgment of the advance authority ruling on this issue, where a tenanted property was being redeveloped and the member got the consideration in the form of shifting or hardship allowance, advance authority ruling applied the that provision of para 5 of schedule 2, the tolerance to do an act or obligation to do an act, that by agreeing to shift to another place, you are tolerating a situation for which builder is compensating to you. Such an absurd provision. And now with the retrospective amendment, if this is not a supply, what is being supplied by the member? Member is only getting his building demolished, his flat demolished, and he is getting another flat in favor of that. Where is the supply into that? So if there is no supply, the schedule 2 could not have come into picture. Shankar Bhanusali, advance authority ruling, I have shouted in my other. Therefore, for the same reason, neither the society, apart from the fact that they cannot be, this transaction cannot be said in the course of business at all. So it fails business test, it fails supply test also. Therefore, a members getting any consideration as a shifting allowance, hardship allowance, monthly rental, even corpus also independent, that is not liable to tax at all. Society is not liable to tax also. And as far as in the new project, like in a city, like in the state like Maharashtra, under MOFA, Maharashtra Ownership of Flats Act, a builder is expected to maintain the project, maybe the same in other states also, till the time the society is formed. And therefore, he has to maintain that project for which he collects in advance maintenance charges. On those maintenance charges, neither service tax was applicable, nor the GST is applicable. That Kumar Baheti judgment is a good law even for the GST also, because this is a statutorily mandated activity which the builder has to undertake, maintain the project, collect the maintenance charges, and he gives the complete, he keeps it in the escrow account. He gives the complete account in the first AGM to the society. And if there is any balance available, he gives that balance to the society. And therefore, this cannot be liable to service tax at all. Friends, I mean, this is I would only call the bird's eye view of all the major issues. There are many. These are all independent topics which one can go on and on. Every independent topic commands more than 2 hours discussion, to be very frank. My only last thing is that right from the day of service tax, it has been my view that commercial drafting of the agreement can be an extremely important thing. Because ultimately it is the contractual arrangement in black and white which will be interpreted, read and analyzed by the department and by the courts. So not only from GST perspective, indirect tax perspective, from all commercial vetting, as we call it, commercial vetting of any contractual arrangement is the must, because law is becoming complicated, regulatory regime is becoming more and more strict, so one cannot be lax. Sometimes whatever both the parties have intended never is found in the written agreement, and the written agreement says something else, parties have understood something else, and actual reality is something third also. And this can be the potent reason for the disputes, legal dispute, unnecessary dispute arising in the context of the indirect tax particularly. With this, I conclude my talk today. I mean, sorry for actually transgressing by a few minutes. And again, once again, I'm grateful to all the organizing bodies for giving me this opportunity to share my thoughts on these crucial aspects of GST law with all the participants, and thank you for the patient hearing. Thank you very much.
Thank you, sir. Thank you for the wonderful deliberation. Your session was really great, interesting and informative. And even in short span of time also, you have discussed with all of us on various practical aspects on real estate sector, like notification relating to RCM work contract is an individual contract or not, and pure construction contract does not cover composite supply or work contract, and on various other aspects like sale of developed plots and all. So thank you so much, sir, for the wonderful session. Now, with the permission of you, sir, we will take our question and answer session.
Yeah, please.
And sir, our first question is, X Limited had taken on lease an industrial land from the state government for 99 years. It builds a structure on it. After 40 years, it has now assigned and transferred the leasehold rights in the said property to A Limited for the balance period of lease. This was done with the permission of the state authorities and fees also paid. X Limited has, from the date of assignment, has no rights or liabilities in or for the said property. Whether GST is payable on such assignment of leasehold rights?
You see, I would like to get into this. I mean, I'm seized of this issue. I'm aware of this academically also. And my immediate opinion, because of the positive time, I cannot go into the nitty-gritty. My state opinion will be that such transfer of development, the leasehold rights, like suppose in MIDC in Andheri in Mumbai, Maharashtra Industrial Development Corporation or West Bengal Industrial Development Corporation, the original leaseholder has acquired the plot of land for say 99 years or 60 years or whatever. And after constructing some building, undertaking whatever industrial or business activity there, he later on actually lock, stock and barrel transferred the entire thing, the leasehold rights also, with the permission of the industrial development body, the corporation body also. In this type of typical three-party agreements, you know, in my opinion, transfer of leasehold right does not attract the levy of GST.
Next question is from Hitesh. Hitesh ji, you can ask your question now. Hitesh ji, am I audible to you?
Hitesh ji, you can unmute yourself.
I think
he's not unmuted himself. Yeah. Okay.
Yes, Avinash ji, you can ask your question. Okay, sir. Our next question is.
Hello.
Avinash ji, boliye.
Yeah, I just want to ask, sir. You have said that a dealer you should charge 5% on the customer to the builder. When the builder will charge 5% to the customer. But while filing the return, the contractor should make full charge and claim full ITC, including the capital goods.
Yes.
In this context, if I charge 5% to the builder, to the customer, when the GST department will put an objection that you have charged 5% and you are taking claim of 18 full tax and ITC, what I'll do?
No, you see, your charging of the rate of tax does not determine your actual taxability in the context of the tariff rate. You are actually charging the customer only because the customer may not agree to 18%.
Right, sir.
If you want to get out of this controversy, you can explain the customer, one can explain the customer also and tweak the prices in such a manner that even after charging 18% to the customer pays the same amount which he would have paid if he would have paid 5%. If one wants to avoid that controversy also.
Right, sir. Thank you, sir.
But the point which I was making is, it will be an individual case, back of the envelope, one has to do the cost benefit analysis that in individual project, in each individual project for each case, whether it is beneficial to go for this line. This is a very radical thought process. And but yes, legally I am very clear in my mind that the 1% and 5% is not mandatory. Now go for the other option is an individual call which has to be carefully taken after undertaking the cost benefit analysis.
Thank you, sir.
And your next question is, will lease rent payable to state government for acquiring an industrial plot will be liable to RCM?
I think that there is this salami and all, there has been an exemption, industrial plot, there is an exemption under notification 11/2017, premium and salami, but otherwise lease rent will be liable. This matter is right now pending in the Supreme Court in SIDCO case, BNM, that is a Builder Association of Navi Mumbai. SIDCO is a Maharashtra-based body and which has charged the premium and rental, premium salami. And this issue is also closely linked to whether this is a tax on the land or building or not. And therefore, Supreme Court judgment also. But going by, I understand the development charges and most of the charges which are actually recovered by the state government bodies from the sector, they are charging or there is a RCM made applicable. Again, as I said, I have reservations about this. This is a debatable issue.
Our next question is, whether sale of additional car park after obtaining completion certificate shall be liable for GST?
You see, I have to, after obtaining completion certificate, if independently anything is sold, it cannot be. If the flat itself cannot be subjected to tax, car parking cannot be subjected to tax at all. Number one. Secondly, whether a builder developer is entitled to sell the parking or whether it remains a common property, it is a hot issue. Most of the judgments, in fact, yesterday one judgment is reported in Times of India, whereby the city civil court has held in favor of the society, whereby the one member had purchased the car parking from the original builder or from the first buyer, and he was using it, and society, got the favorable wording from the civil court that member has to surrender this parking to the society. It is a part of the common amenities. So whether one can sell the parking or not, that's a debatable issue.
Sir, our next question is, once completion certificate has been allotted to a project, then no GST is payable. Any other tax implication on builder since government is not getting any tax?
No. It is not the question of whether government is getting any tax or not. What the artificial demarcation line has been created in the point of time is that on the date of issue of the certificate, anything subsequently sold is a immobile property. And because immobile property cannot be subjected to service tax or GST, though prior to that, whatever construction activity is undertaken, where the buyer is already in the picture, that has been treated as a works contract liable to VAT under previous regime and service tax, and now under GST. Therefore, here it's a deliberate, because it's a constitutional mandate. You can't levy the GST on the immobile property. And post-completion certificate, what is undertaken is a sale of immobile property in the form of the constructed unit, whether commercial or residential.
Sir, I think you have taken all the questions. So thank you so much, sir, for the wonderful deliberation and for wonderful question and answer session also. Now, I would like to invite Suresh Agarwal, sir, for the vote of thanks to our speaker.
Thank you, Shilpa-ji, for giving me an opportunity. Good evening to all participants in the webinar. Sir, I remember the day when inaugural day was celebrated on 1st of July 2017. Our Prime Minister has made a statement that the return would be so simple, GST return will be so simple that even the common man can feel it. But all of you know how much it is simple as of now, even after 4 years. The same way, this simplicity is possibility only when the organizations like us, like 6 organizations are today celebrating these functions and organizing the seminars or the webinars. So this way we can understand what is going on in the present positions, and we are thankful to the organizers who are inviting such a legend professionals and the speakers who made us a simple law for us to understand and follow it properly. So in the today deliberation, our Shailesh Sethji has given a entire thought of view on the composite supply, indivisible contract, work contract, development agreement, builder agreement, development right. He has tried his best to give the entire pictures relating to the real estate sectors and give us a knowledge so that we can fulfill the present position of law and procedure in the real sector. Thank you for this. Thank you to all organizers and the participants and the Shailesh Sethji for giving such a nice deliberation in the today webinar. Over to Tarunji, please.
Thank you very much, sir.
Yes, thank you, sir. And as a small token of our love and appreciation, yes, sir, we present to you this e-memento, sir.
Thank you. Thank you very much.
This will be emailed to you, sir, and we will request if you can take a color printout of this and frame it and keep it in your library. This will also, sir.
But Tarunji, you also owe me the physical actually say also.
Sir.
Absolutely, sir. Absolutely.
Yeah.
Ekdam, sir.
Thank you very much.
Thank you, sir. Thank you so much, sir.
And once again, my sincere apology for just crossing, but this was a subject where, I could have not really quizzed it and do the injustice to the topic which I wanted to cover. I hope, and my sincere apology to the next learned speaker also. I'm sure we will extend the time up to 7:30 to tomorrow. Thank you very much, because we started late. So I needed to cover this.
Thank you, sir. I think all the participants have really liked your deliberation, and we will. I'm just informing that Shailesh Seth sir has shared his presentation which we will share with all the participants. So thank you so much. And now we will go to the next technical session. Thank you, Shilpa ji. Thank you, Suresh ji, for
thanks to all from my side also.
Moderating the session so nicely. And thank you, Suresh ji, for giving the vote of
with all of your permission, I will also leave. And Zubin ji, namaskar. Thank you very much.
How are you?
Bas fine, sir. Thank you very much. Thank you. Bye. All the very best.
Thank you, sir.